Welcome to the Deep Dive. We're here to give you those critical synthesized market insights straight from the source data. Today, we're diving deep into a really explosive sector move. It's a real-time expert journalistic stock report on the top U.S. drug manufacturers. We're talking Pfizer, that's PFE, Merck, MRK, and Bristol-Myers Squibb, BMY, all following some massive news on drug pricing and tariff clarity.
That's right. I mean, when political events hit the pharma sector, you usually expect chaos, right? But this was, well, it was different. Our mission today is to cut through that noise. We'll unpack the screener data, look at the performance, the valuations, the technicals for all three of these giants. We're looking at a market that reacted, frankly, violently, pushing the whole sector up record highs in just one day.
Yeah. Quite something. And just a quick note for you listening, we're analyzing public data here purely for educational insights to illustrate market dynamics. This chat is based on the source material we looked at, and it's definitely not investment advice.
Absolutely. So the event we're dissecting, it's that incredible single-day performance back on October 1st. Get this. Pfizer jumped 6.79%. Merck soared 7.39%, and BMY gained 5.17%. When you see that kind of synchronized jump, I mean, that's a huge flashing signal. A big macro driver is definitely at play.
Okay, let's unpack that then. A sector that's, historically been pretty volatile because of pricing pressures, suddenly rockets. What exactly came out of Washington and the labs? What ignited such a fierce, synchronized rally across all three?
Well, the main force was political. You might have heard it called the Trump RX plan and all the talk around tariffs. The administration had been threatening this really severe 100% rate on patented drugs, and that just created this massive suffocating uncertainty for these companies.
Okay, but tariffs and pricing cuts. That sounds like bad news, right?
Yeah.
So why the surge? Why didn't the market just collapse?
Because the news actually delivered clarity. That was the key. Pfizer apparently reached this landmark agreement with the White House. They agreed to cut some drug costs, and in return, the market perceived they got a massive exemption, or at least favorable treatment, on those punitive tariffs. So PFE soared on the relief, and it's huge, right? $154 billion market cap. It basically pulled its peers, MRK and BMY, right up with it. It showed the whole sector that maybe deals, even politically charged ones, could stabilize things, remove that worst-case scenario risk.
Interesting. But looking purely at the data, it wasn't just political relief driving this, was it? I mean, there was some significant, genuine clinical success mixed in there, too.
Oh, absolutely. You're spot on. The political tailwind was definitely matched by some strong pipeline wins. Take Merck, for example. Their big bump wasn't just the tariff news. It was also stellar Phase 3 trial results for their pulmonary hypertension drug, WINREVAIR. That's sotatercept-csrk. The data showed a massive 76% risk reduction. For a serious condition like that, well, that's a major fundamental driver. Helps offset other long-term worries.
And BMY had its own good news too, right?
It did, yeah. Bristol-Myers Squibb got fast-track designation from the FDA. It was for their Alzheimer's drug candidate, BMS 9864446. Now, fast-track doesn't guarantee approval, of course, but it speeds up the review process for serious conditions like Alzheimer's, and that definitely injected some much-needed positive momentum into a stock that, frankly, has been struggling a bit lately.
Fascinating mix then. Macro relief meets micro innovation.
Okay.
Let's dive into the core data. Starting with Pfizer, PFE. Often seen as a value play, right? Huge dividend yield, currently 6.26%.
PFE is a bit of a puzzle right now, actually. It's valuation. Well, it closed with a trailing PE of 14.47. Not super cheap, not super expensive, average maybe. But here's the crucial insight, I think. Analysts project the earnings to share growth. The projected growth over the next 5 years is extremely low. We're talking just at 0.06%.
Wow, 0.06%. That's essentially flat growth. How does a company with that strong dividend and positive sales growth this quarter up 10.31% QQ have a near zero long-term growth projection?
Yeah, it's quite the combination, and that combination for me is a massive red flag. It suggests the immediate market euphoria might be masking some long-term stagnation issues. It strongly implies the market thinks this political relief and the current sales bump are just going to offset major revenue declines coming down the pike. Patent expiries, loss of exclusivity on blockbusters, the COVID revenues tapering off. This deal might have just bought them some time rather than fixing the fundamental growth challenge.
So the high dividend is basically compensation for that low future growth expectation. Okay, let's look at the technicals then, because that rally was violent, almost 13% in 1 week.
The momentum is undeniable, absolutely. Performance last week, plus 12.95%, supported by huge trading volume, too, a relative volume of 3.31. That's significant. Technically, all the key moving averages, the 20-day, 50-day, 200-day, simple moving averages, they're all significantly positive. That signals a confirmed long-term uptrend might be underway. That SMA alignment, that's a strong buy trigger confirmation for strategies betting on a major breakout.
Okay, but when a breakout is that rapid, that fast, it often triggers a temporary cooling off period, doesn't it? What are the oscillators telling us?
Exactly. The speed, the velocity of the move pushed the relative strength index, the RSI 14, way up to 74.20. And remember, anything over 70 on the RSI typically signals that a stock is technically overbought, at least in the short term. So this creates a bit of a technical conflict, right? Long-term trend followers see that SMA alignment as a buy confirmation, but short-term traders, they see that 74.20 RSI as a potential sell trigger, a signal maybe it's time to take some quick profits before a likely pullback.
Right, makes sense. Let's quickly run the paper money math on PFE. Say you put $3,333.33 into Pfizer a week before this surge, capitalizing on that 12.95% gain.
Yeah.
What's your approximate paper profit look like?
Okay, so that $3,333.33 investment, assuming you bought around $24.09 a share, let's see, yeah, that would have yielded a paper profit of approximately $431.66 in just 7 days. It really shows the power of that sector-wide relief on these big established names.
Incredible short-term gain. Okay, moving on to Merck, MRK. The behemoth of the three, right? Largest market cap at $225 billion. Merck seems to have maybe the most solid foundation underpinning its rally.
Yeah, I'd say Merck is the picture of health in this group, relatively speaking. It boasts the lowest PE of the three, sitting at 13.90, so it looks relatively inexpensive. But the financial metrics underneath are really outstanding. Their gross margin is commanding 75.25%, profit margin 25.87%. They are incredibly efficient at turning revenue into actual profit.
And their future growth projections look strong, too, avoiding that stagnation risk we sort of saw with PFE.
Correct. The expected EPS growth over the next 5 years, 11.13%. That's solid. Their PIG ratio, which, relates the PE to that future growth, is at a reasonable 1.25. Plus, their debt profile looks favorable. Debt equity ratio is only 0.72. They really have the financial strength and the low leverage to confidently keep investing in R&D.
So tell us a bit more about the innovation driving this. We mentioned WINREVAIR, but there was also news about KEYTRUDA, their massive cancer drug.
Ah, yes, the KEYTRUDA news. That's a strategic masterstroke, really vital for managing the upcoming loss of exclusivity, the LOE. MRK got approval for a subcutaneous formulation that's under the skin. It dramatically cuts the infusion time for KEYTRUDA from hours down to about 2 minutes. That's a huge competitive advantage, a clear fundamental driver. It helps extend the drug's market power, beyond the original patent date. This clinical success is a big reason why MRK's RSI also popped up to 70.08. Confirms that high enthusiasm and strong short-term momentum.
So the market's betting on innovation winning out over patent risk there. Okay, let's tally the paper results for Merck. If we put our second third, $3,333.34 into MRK last week, what would that gain look like?
Well, given their exceptional weekly gain of 13.13%, actually the highest of the three, that investment would have yielded a paper profit of approximately $437.91. Again, just phenomenal gains, driven by that combo of political clarity and real pipeline success.
All right, now let's pivot to the final one. Bristol-Myers Squibb, BMY, smallest by market cap, $96.5 billion or so. But this is the one where the valuation metrics create the biggest puzzle, right? This is where it gets, as you said, really interesting.
Yeah, BMY. Okay, so it has a higher trailing PE at 19.14, but its valuation looks, well, exceptional based on its growth expectations. Its PEG ratio is extremely low, 0.27.
0.27, wow. I mean, a PEG below 1.0 often signals deep undervaluation.
Yeah.
But 0.27, how can the market justify keeping the price so depressed with a number like that?
That incredibly low PEG is driven by an astonishing projected earnings growth rate. We're talking 72.90% over the next 5 years, projected, of course. So the market sees this potential for massive profit growth, probably driven by their pipeline and some recent strategic shifts. However, and this is a big however, you have to factor in the counterbalance.
Right.
BMY carries a debt equity ratio of 2.92.
Whoa, 2.92. That is substantially higher leverage compared to MRK's 0.72 or even PFE's profile.
Precisely. So the market is deeply skeptical. Can BMY actually execute on that massive 72% growth projection while also servicing that very heavy debt load? That high leverage translates directly into high execution risk. And that is why the price is suppressed, despite the phenomenal growth outlook, which leads you to that very attractive but also quite risky 0.27 PEG ratio.
Got it. So high potential growth, but matched with high debt and high risk. Did the political rally manage to pull BMY out of its longer-term technical slump?
Well, it gained a healthy 7.40% last week, which is great in isolation, but no, not entirely. BMY is still technically weaker from a long-term perspective. Even after that strong rally, the stock remains about 8.05% below its 200-day moving average, the SMA 200. That means despite the daily surge, BMY is still technically in a long-term downtrend. For technical analysts, the stock hasn't really confirmed a true shift in sentiment just yet. Needs more proof.
Okay, let's close out our individual paper math on BMY then. Investing our final third, $3,333.33, was the profit realized on that 7.40% weekly gain.
That slice yielded a paper profit of approximately $246.66. It was the least volatile and the slowest mover of the three last week, which kind of reflects that underlying market skepticism, that debt concern that we just discussed.
All right, that brings us to the wrap-up, the comparative synthesis. We hypothetically invested $10,000 split roughly equally across PFE, MRK, and BMY right before this political storm cleared up a bit. Looking across the three, what does the data tell us about the winners and maybe the sector as a whole?
Yeah, when you put them side by side, the differences really sharpen the competitive picture. Merck, MRK, clearly leads in financial health. It had the lowest PE, the highest margins, and the lowest debt. Just solid fundamentals. PFE and MRK showed the most powerful technical breakouts driven by the news. Both pushed into that high RSI territory, over 70, confirming that immediate positive reaction.
And BMY is the outlier, offering the highest risk-reward scenario. That compelling low peg of 0.27 signals may be exceptional value. If they can navigate the heavy debt load, that 2.92 did equity, and actually hit that projected 72% growth. Big if.
Exactly. It's the high wire act of the group.
Yeah.
But bringing it all together for our hypothetical portfolio, that initial $10,000 paper investment, it's now valued at approximately $10,996.56. That yields a total paper gain of nearly $1,000 in just 1 week, a nearly 10% portfolio return. It just highlights how massive the short-term impact of regulatory clarity of these political deals can be on this entire sector.
So boiling it down, what does this all mean for you, the learner, watching this space? We've seen three major drug companies lifted by, well, a perfect storm, really. Policy clarity plus individual pipeline success. The market clearly prefers clarity, even if it comes with things like mandated price cuts over that crippling uncertainty we saw before.
Yeah, and I think this raises a really important question for everyone looking at this sector going forward. We've seen these phenomenal short-term gains, right, driven largely by political deals, and the resultant volatility unwinds. But how much of this newfound altitude, this higher stock price, is sustainable excitement over what might just be a temporary brokered deal? And how much is based on genuine long-term innovation that truly affects the company's competitive position? You know, things like Merck's ability to extend Keytruda's life with that new formulation, or BMY's ability to execute on growth despite its high debt. That ongoing conflict, that tension between the political market movers and the core fundamental health of these companies, that's really what you need to track in the coming quarters. It's the key dynamic.